Have you ever wondered what the largest private companies in the world do? Check those revenues. Trafigura, 380 billion. Kofco, 75 billion. Cargill, 165 billion. Mercuria, 164 billion. Vitol, 505 billion. All those companies are commodity trading companies. And the general population has probably never heard of them, even though they touch, use, consume every day something that has been handled by those giants in the shadow. In this video, I'm going to explain what commodity trading companies do. In the first part of this video, I'm going to give you a formal answer, what the CEO of those companies would say as an acceptable answer about their activities. And in the second part of this video, I will give you the real reason, actually the two real reasons why those companies swim in money. Modern commodity trading companies add value through the supply chain by purchasing commodity, transporting commodity, storing commodity, processing commodity, selling commodity. Let's review those 5 core activities. An uninformed person would say, I don't understand why purchasing, buying is a value-added activity. I mean, buying is something straightforward, no? So, no, it's not straightforward. Buying a large quantity or a large sum of anything internationally is quite complex. Think about it. So let's say that you own a factory and that you produce cleaning chemicals. And you want to buy a container of commodity worth of 100K of those chemicals out of China. So what do? Do you send a wire for 100,000 US dollars to the Chinese company? But what happens is the shipment is delayed and you've got to stop your factory because you don't have enough raw materials. What happens if the quality is not right? What happens if the company just takes your money and then doesn't ship you the good? Are you really going to take a legal action in China for 100K? And what happens if the custom stops your container at the border because the producer didn't supply an important document? And when you ask the producer to supply it, you just say, what do? Oh, and this one is for European companies, especially European companies. What happens if when you send your wire to China, your bank called you up and say, oh, look, I didn't know that you do business with China. What is going on here? But I'm sorry, sir. I really like you. But you know what? The cost of compliance of someone working with China is too high for us. So we are going to close your account. Ciao, ciao. International transactions are hard. So this one is easy to understand. People need oils in New Zealand. There's no oil there, so you need to ship products there. Trucks, train, brakes bolts, containers, tankers, everything is used to supply commodities. As commodities are usually a low value product, it's needed to be transported in high volume to reach an economy of scale. Here again, it's easy to understand. The consumption and the production of each commodity do not really match. For instance, we eat bread all year long, but there is only 2 harvests of wheat a year. So who is going to take the risk of financing and storing the wheat in between those harvests? Because if you put yourself in the farmer's shoes, your grain is your money. So you maybe can't wait for your clients to need the grain to get paid. You need to pay your employees, your machinery fuels, new seed, and so on. This is why you need a client to be able to pay. Over time, commodity firms have expanded downstream and upstream the supply chain. So that was a normal transition for them to become commodity processor. And by commodity processor, I mean being able to transform commodities into raw materials or ingredients. For example, Olam or Cargill, they buy cocoa beans, but they also grind them to produce cocoa powder to sell them in 25 kg bags. So I'm not going to spend too much time on sales as this is pretty much the same problem as purchase, but the other way around. The only thing is that now clients always want credits from their suppliers, meaning they want 60 days or even 90 days to pay the product, even though the commodity has already arrived in their facilities. Now I'm going to give you the two reasons why commodity trading firms are destroying their competition and taking the place of most of the actors through the supply chains. We have seen the 5 core activities of a trading firm, but to support those activities, the company needs a lot of money. As the world is getting more and more financialized every day for the last 50 years, it has skewed the market and has been rewarding handsomely the actors that manage to get cheap financing. And trading firms are the best at getting cheap money. Therefore, they are minimizing the ability of other players, other competitors to expand downstream or upstream. But let me give you a concrete example. Let's say that you have a small mine and every month you sell for 5 million of copper cathodes. To reach its customer, the copper needs to be transported for 60 days or so. If you are a small mine, your cost of financing is going to be around 12% per annum. So that means that you are going to pay 100K in financing fees for the good to reach its destination. And the math is easy. If you pay 12% per annum, it's 1% per month. 1% of 5 million, it's 50K. It takes 2 months to reach the customer, so this is 100K of financing that you get to pay. Now, if you are competing with traders that have a cost of financing of 4%, it would make more sense for you to sell directly to the traders to get paid as soon as the good has left your mine and let the trader finance the transport to your customer. That would be the most optimized way. Now, let's speak about the second reason. A trader makes money when his perceived risk-reward ratio is different than the market risk-reward ratio. It means that if a transaction is deemed too risky by the market, if you as a trader you close it, you are most probably going to make a good amount of money. For instance, prepaying a local mine in South Sudan or giving credits to a group of armed rebels for their fuel needs, those are extremely risky transactions, but of course if you close them, you must make a lot of money. But of course, this is two extreme examples, but I guess you get the idea. On the other hand, when there is no perceived risk by the market, then it's going to be extremely difficult to make money as a trader, to find an arbitrage, and you will probably have to speculate if you want to close any deal. That's it for me today. I hope that you liked the video and that you learned something. And if you want to break into the world of commodity trading, first link in the description below. Ciao.